Hi there, welcome to the second and final video of this week. In this video, we are going to look at IAS 36 Impairment of Assets. In the first video, we considered intangible assets under IAS 38, and we looked at specifically purchase goodwill from IFRS 3 business combination. Impairment of assets, IAS 36, is a very important standard. Given the current pandemic and the situation that we are in, many companies will have impairment losses in their financial statements. So it is important that we learn how such impairment losses are calculated. Here are the learning outcomes for this video. First, we define what an impairment loss is. Then we'll try to understand some terminologies such as recoverable amount, value in use, and the likes. Now, usually, a company will undertake an impairment review when there are indicators of impairment. So we'll we'll try and ascertain what indicators will trigger impairment review. Then we consider how to recognize and measure impairment losses. We extend that knowledge to the concept of cash generating units. When you review a group of assets together rather than on an individual asset basis. Then how do we allocate such impairment loss in a cash generating unit? And we'll conclude this video by looking at the disclosure requirements under IAS 36. So first, let's consider some definition. What is an impairment loss? IAS 36 defines an impairment loss as the amount by which the carrying amount of an asset or the cash generating unit exceeds its recoverable amount. Well, it's a very simple concept. The concept is that you cannot carry an amount in the financial statements for more than what you can recover for it. So if you have a carrying amount in the financial statement of £10 and you can only recover £8, then that asset is impaired in value. You must write it down to £8. Otherwise, the financial statement becomes deceptive, because it's showing values that the entity cannot recover. That is a simple concept. So that means we need to know what is recoverable amount, what is carrying amount. So impairment loss, therefore, is a fall in value of an asset so that its recoverable amount is now less than its carrying value. Carrying value is usually the net book value in the statement of financial positions. So if we look at this diagram, this is the amount at which the asset is carried in the statement of financial position. If this amount is greater than what we can recover that asset for, we have an impairment loss. So we'll look at the definition of recoverable amount in a minute. So basically, an asset cannot be carried at an amount which is greater than what it can be recovered for. And that is the essence of impairment testing. In general, IAS 36 applies to all tangible, intangible, as well as financial assets, except for inventories, IAS 2. We'll look at that separately. Revenue from contracts, IFRS 15, again, we'll look at that separately. Investment properties we've already considered, and non-current asset held for sale, IFRS 5. Aside from this, IAS 36 applies to all other non-current assets, whether they be tangible or intangible. What is recoverable amount? The recoverable amount is the amount that an asset can be recovered for. The best way to look at that is that when we have an asset, we either use it, or if we can get a better value for selling it, we sell it. So whichever is higher. So therefore, IAS 36 defines recoverable amount of an asset as the higher of the fair value less cost of disposal and its value in use. So what is fair value less cost of disposal? Well, that is the price that would be received to sell the asset in an orderly transaction between market participants at the measurement date, less whatever the disposal cost may be, like selling cost. Value in use, on the other hand, is the present value of the future cash flows that are expected to be received or derived from the use of an asset, including the eventual sale of it. So, in essence, the recoverable amount is therefore the higher of value in use, which we said is the present value of future cash flows expected to be derived from the use of an asset, or the fair value less cost to sell. Fair value less cost to sell. In other words, if we have an asset and we know we are going to derive more from using it, we will hold it. But if we're going to get more from selling it, then we will sell it. So whichever is higher is the recoverable amount. In simple terms, if we are going to get 10,000 from the use of the asset and somebody offers us 12,000 for it, we will sell it and keep it for 12,000. So in effect, the asset cannot be carried at more than 12,000. If it carried at more than 12,000, supposing the value of the asset, the carrying value is currently 13,000, it means that that asset is impaired to the tune of 1,000. So it cannot be carried at more than the recoverable amount, full stop. Diagrammatically, this can be represented as follows. The carrying value cannot be higher than the recoverable amount. So we cannot carry this asset at more than what we can sell, recover it for. So we have to choose the lower of those two. So this is what is currently in the statement of financial position. If this one is less, then we have an impairment loss, and that loss must be written off. So we have to write it down to the recoverable amount. As I said earlier, the recoverable amount is a higher of the fair value less cost to sell, what you can sell it off for less net selling cost, or the value in use. So if you can get better value for using it, you will use it. If you can get better value for selling it, you sell it. So whichever is the highest of these two is your recoverable amount, and therefore the asset cannot be carried at more than that. It can be carried at less than that, which is great because you recover the cost plus a profit, but you can never carry it at more than the recoverable amount. Entities don't have to undertake impairment testing every year unless you are specifically required to. For example, for goodwill, purchase goodwill that we discussed earlier, the standard IFRS 3 requires that annual impairment testing be undertaken for purchase goodwill. In the absence of such explicit requirement, you only undertake impairment review when there are external or internal indicators of impairment. When something tells you that there are indicators, there is likely to be an impairment. So the indicators could either be external or internal. In terms of external indicators, these are decline in the market value of the asset. So if the market value of the asset has fallen dramatically, it means you can sell it for less. So that means we have to test to see if the recoverable amount has fallen. Adverse technological or market economic or legal changes, such as we have it under the coronavirus. So these are adverse market economic changes. So that will trigger impairment testing. Any increase in the discount rate, to calculate the value in use, we use discount rate. The higher the discount rate, the lower the value in use. So when there is an increase in discount rate, that would be a trigger for impairment review. Carrying amount of the entity's net assets exceeds the market capitalization. So if the market capitalization is low, market capitalization is, of course, the number of ordinary shares in issue times the share price on the market. So if that is lower than the carrying amount, that also is a trigger for impairment review. From an internal perspective, the internal indicators would be evidence of obsolescence or physical damage to the asset. So if the asset is damaged, then that is indicative of a possible impairment loss, and it will trigger impairment review. The asset has become idle. So if it is idle, it is no longer generating income, and therefore the value in use is likely to drop significantly. Any plans to discontinue the operation in which the asset is used, again, we're not going to get any value from the asset because the operation has now discontinued. Plans to dispose of the asset. Useful life of the asset is reassessed as finite, so forever, not for a fixed period. And there is evidence that the asset's economic performance will be worse than expected. Any of these events, whether it be external or internal, will trigger impairment review. Simply, how do we undertake the impairment review? Well, the exercise is to look at the carrying value of the asset and then compare it to the recoverable amount. So first thing is to calculate the recoverable amount. If you remember, the recoverable amount is a higher of fair value less cost to sell and the value in use. So you need to calculate that to make sure that the carrying value is not higher than the recoverable amount. So if the recoverable amount of an asset is less than its carrying value, then of course that carrying value, that asset is impaired. The carrying amount should then be reduced to its recoverable amount. The amount of this reduction is what we call impairment loss. So going back to that diagrammatic representation, assuming we've got 12,000 here and we've got 14,000 as value used. So this is 12,000, this is 14,000. That means that the recoverable amount is therefore 14,000. If we are currently carrying this asset at 15,000, then we have an impairment loss of 1,000 because it's 1,000 in excess of the recoverable amount. So we have to deduct or write down this loss from 15,000 to 14,000. That's basically what it means. So there's an impairment loss. So if the recoverable amount of an asset is less than the carrying amount, then that asset's carrying amount should be reduced to its recoverable amount. The amount of this reduction, in our example, £1,000, is the impairment loss. How do we reduce it? In general, the impairment loss will be recognized as an expense. So if the asset is depreciated or amortized, wherever you charge the depreciation to, wherever you charge the amortization to, you charge the impairment loss to the same place. So you charge it to that same place. But if the asset is revalued for revalued assets, an impairment loss is first debited to the valuation reserve, other comprehensive income, to the extent of any credit balance that is previously existing in that reserve in respect of that same asset. And that will be shown as a negative figure in other comprehensive income. Any excess is then recognized as an expense. Exactly the same way we treat revaluation loss. It's exactly the same principle. Let's use an example to illustrate. We have a non-current asset which is currently included in the statement of financial position at carrying value or net book value of 500. We have undertaken the impairment review by calculating the fair value less cost to sell as 400,000 and the value in use is 450. Show the accounting treatment for impairment. Now, usually the carrying value, the recoverable amount, is the higher of these two. So in this case, the recoverable amount is 450. That means the asset cannot be carried at more than 450. But as it is carried at more than 450. We are carrying it at 500,000. Therefore, there's a 50,000 impairment loss. There it is. So calculate first of all the recoverable amount, which is the higher of the fair value or the value in use. As it appears, the value in use is higher. Therefore, the asset cannot be carried at more than 450. So if we compare this to the carrying value of 500, we have an impairment loss of 50 because we are carrying it at more than the recoverable amount. So the impairment loss is 50,000. How do we account for this impairment loss of 50,000? The impairment loss, if it is for the first time, if the asset had never been previously revalued, then it is taken to profit and loss. So you credit accumulated impairment loss in the statement of financial position, which is non-current asset, and debit income statement, where you would normally charge the depreciation to. So income statement, you charge it to where you would normally charge depreciation to 50,000 and the credit to net book value, 50,000. So that reduces the net book value of the asset from 500 to 450. That is how simple impairment is. The calculation of impairment losses is relatively simple, but the understanding of the principle can be daunting. What if the asset was previously revalued? How would you then deal with the same question? So here's an example. The non-current asset is currently valued at the net book value of 500. This asset had previously been revalued with a balance on the revaluation gain of 30,000. Again, the impairment reviews reveals that fair value is 400, value in use is 450. Show the accounting treatment. So again, first of all, you compare these two and you take the higher figure, which is 450. The asset cannot be carried at more than 450, so we're carrying it currently at 500. Therefore, there's an impairment loss of 50. Exactly the same principle. So the recoverable amount is 450. The net book value is 500. Coverable amount being 450. So we have an impairment loss of 50. However, going back to the question, this asset was previously revalued such that 30,000 was in a revaluation reserve as a revaluation gain. So in that instance, 30,000 of the 50 will go to other comprehensive income, negative revaluation. Only the balance of 20,000 will now be written off to profit and loss. And as you can see here, so 30,000 of the impairment loss is charged to the revaluation reserve, so negative revaluation. The excess of 20 is charged to profit or loss as an operating expense, and the net book value of the asset is of course reduced by 550,000. So you debit revaluation reserve with 30, you debit income statement instead of 50, you debit it with the balance of 20, and then reduce the asset at 50. Again, this is similar to the exercise we did for revaluation loss. An asset that was previously revalued at a gain, which is now revalued at a loss. Simple exercise. And that is impairment. Fairly straightforward to understand once you get the gist of it. Sometimes it is not always possible to undertake impairment review on single items. You may have to do it on a group of items. So for example, goodwill may have to be assessed in conjunction with other items. So such group of items are referred to as cash generating units. IAS 36 defines a cash generating unit as the smallest identifiable group of assets that generate cash inflows that are largely independent of cash inflows from other assets, or that group of assets. So the company may be able to find out which part in the business are able to generate cash inflows separately or independently of the rest of the entity. So that particular unit will be referred to as a cash generating unit. What you do is to add up all the assets of that unit and compare the value of the assets of that unit to the recoverable amount of the unit. Of course, if any assets within that unit has an impairment, so if the recoverable amount of an individual asset, which might be impaired, cannot be determined, then the recoverable amount of the CGU to which that asset belongs should be determined instead, and an impairment loss should be recognized if the recoverable amount of the cash generating unit is less than the carrying amount of the assets within that unit. So, in this case, you add up all the assets within the unit, you add them up and compare them to the recoverable amount. If the total assets exceed the recoverable amount of the unit, you will then have an impairment loss. How then do you account for such impairment loss? Well, an impairment loss for a cash generating unit should be recognized by reducing the carrying amount of that unit's assets. But you are located between the assets in the unit. First of all, you set it against any goodwill within that unit. You write off the goodwill to the end until there's nothing left. If there's still more losses left after writing off the goodwill, then the balance of the loss will be allocated between the remaining assets in proportion to their carrying amounts on a pro rata basis. So the carrying amount of the asset should not be reduced, of course, below the highest of the fair value, less cost of disposal, and of course the value in use. You cannot reduce any particular asset within the unit below the recoverable amount. It is possible that events may change in subsequent years so that the impairment loss may be reversed because of changes in events. So if subsequently an impaired asset recovers its value, then you reverse it in the year of recovery by increasing the carrying value of the asset to the lower of the recoverable amount or the original carrying amount. So whichever is lower. And that reversal is recognized immediately in the profit or loss or income statement in the year of reversal. However, once you have calculated impairment loss on goodwill, you can never reverse it. Impairment loss on goodwill is never reversed. Here's an example of previous asset that was previously impaired and are reversed. So here we are, following the 50,000 impairment, following the 50,000 impairment that we did in the previous example, a non-current asset is currently included in the statement of financial position at the net book value of 450. So if you remember, we wrote it down from 500 to 450. Now we've undertaken another review. The fair value is now 480, value in use is 450. Therefore, the recoverable amount has increased to 480. And because this is now more than 450, we can now reverse 30,000 back into the accounts. So show the accounting treatment of for the impairment. So the fair value is now 480, which now becomes the recoverable amount. The recoverable amount is 480, the net value is 450, so the impairment reversal is 30. So in this case, we basically credit profit or loss account with 30 and debit the non-current asset with 30 to increase it. So you debit non-current asset 30 and credit income statement with 30. And that concludes the investment exercise, impairment exercise. In terms of disclosure, for each material impairment loss or reversal recognized during accounting period, the entity should disclose the amount of impairment loss recognized, amount of an impairment reversal recognized, amount of impairment loss and recovery recognized on assets that were previously revalued, the nature of the impairments, and whether recoverable amounts is value in use or fair value less cost to sell that asset, and how these were determined. As I said earlier, impairment is a very, very important standard, IAS 36. So you'll find a series of questions on this to help understand and embed your learning on this. I strongly recommend that you practice the exercise. Please feel free to ask me questions if there is something you do not understand. But in essence, in summary, the standard IAS 36 simply requires that an asset cannot be carried at more than what we can recover it for. Normally, we recover the cost of the asset either by using it or selling it, whichever is better. So if we're going to get more for selling it, we will opt for that, and that becomes the recoverable amount. Therefore, we cannot carry the asset for more than that. That concludes the second video for this week. I hope you've enjoyed the 2 series of videos, and also I hope you enjoyed the discussion that we follow through with this. Have fun, get engaged. See you soon, and stay safe.